What if I told you that a tiny, greasy fast food building wedged right next to a highway off-ramp is actually considered infinitely more valuable to the ultra-wealthy than, like, a sprawling luxury mansion?
I mean, it sounds totally counterintuitive.
Right. Because when you or I look at real estate, we usually look at the physical structure. We look at the granite countertops or, the curb appeal.
Exactly. You're looking at the paint job.
Yeah. But today, we're taking a look at a literal menu of multi-million-dollar commercial properties. And the people buying these, well, they aren't looking at the paint job at all.
Not even a little bit. They're looking at the math hidden underneath the concrete.
Which is exactly why our mission for this deep dive is to peek right behind the curtain of high-stakes commercial real estate.
It is such a fascinating ecosystem, really, because it dictates the entire layout of the world we interact with every single day.
Yeah, but the rules governing it are, like, almost entirely invisible to the average consumer.
Oh, completely invisible. And to shed some light on this, we have a highly specific, curated source in front of us today. It's a May 9th, 2026 newsletter titled EBG Listings of the Week.
Right, from Eureka Business Group.
Yep. They're a commercial real estate brokerage that was established back in 2008. They are managed by Joseph Goslin, and they heavily specialize in the Dallas-Fort Worth, or, DFW market.
So we aren't just here to gawk at massive price tags today. We want to decode these specific strategies that investors actually use to generate wealth, from the strip malls, the dental offices, and the drive thrusts that you pass on your morning commute.
Absolutely.
Okay, let's unpack this, because before we even look at a single property listing, we have to grapple with the incredibly confident, almost bizarre state of the market that EBG describes right at the top of their newsletter.
Yeah, their opening macro summary paints a picture of a spring market that is just accelerating rapidly.
Like aggressively fast.
Exactly. They point out a higher volume of activity, a lot more listings going live, and deals being struck at a pace where they explicitly warn buyers, like, hey, good opportunities are vanishing instantly.
And they drop one line in that summary that genuinely made me do a double take.
Oh, I know the exact line you're talking about.
Right. They write, "What about the war? Seems like the commercial real estate world doesn't really mind it."
Yeah.
It reads like the commercial real estate market has noise-canceling headphones on. Like, how does an entire sector of finance just casually ignore major global turbulence?
Well, what's fascinating here is that institutional wealth and private capital, they aren't actually ignoring global turbulence. They're actively reacting to it.
No, so.
Well, in times of extreme unpredictability or, geopolitical stress, sitting on cash is dangerous because inflation just erodes its value.
Right, cash loses its purchasing power.
Exactly. So investors flee the stock market's volatility and they seek out physical, tangible assets that act as a sort of storm shelter.
So real estate becomes the safe haven.
Bingo. And the data in the newsletter totally backs this up. The Eureka Retail Velocity Index for April 2026 scored a 7.1 out of 10 in the DFW market.
And that is a 1.2-point jump from the previous month, right?
Yes, which is huge.
So since that index measures transaction speed and volume, a jump like that means money is just flooding into these assets right now.
Flooding in. And EBG highlights exactly where that money is hiding. The velocity is being driven by what they call large format and longer-term leases.
Okay, so locking in safety.
Right. The goal during global instability is to lock in long-term inflation-resistant safety. I mean, even though EBG notes that overall vacancy edged up slightly to 5.1%, landlords in prime locations are still holding all the leverage.
That's wild. So rents are actually rising.
Rents are rising, yeah. And there is a heavy shift toward what they call NNN, or triple net leases.
NNN. Man, if you want to understand how wealth preserves itself, you really have to understand those three letters.
You absolutely do.
Because the EBG newsletter categorizes its properties by investor strategy, starting with assets under $3 million. And this entire tier is basically an exercise in manufacturing absolute safety.
Yeah, this is essentially the zero-effort bond strategy. It's heavily populated by single-tenant retail properties, particularly quick-service restaurants or QSRs.
Fast food.
Right, fast food. The investor here is not looking for a part-time job as a property manager. They don't want to fix toilets. They're looking for a reliable passive yield.
And the ultimate example they list here is a Jack in the Box down in the Colony, Texas.
Oh, yeah. Great example.
It's this tiny building, just under 2,900 square feet. But the magic words in the listing are absolute NNN lease and corporate guarantee.
Yes.
Let's break that down for a second, because NNN is often used as a catch-all, but the details actually matter a lot.
They really do.
So an absolute NNN lease is basically like owning a golden goose, but you legally require the tenant to pay for the goose's food, the vet bills, and any repairs to the coop.
Right. That is a highly functional way to look at it, yeah. I love that analogy.
Right.
Because in a standard NNN lease, the tenant agrees to pay the property taxes, the building insurance, and the maintenance costs, on top of their base rent.
Right.
But a true NNN lease sometimes leaves the landlord still on the hook for the roof and the structure. So if a tornado damages the building, your phone still rings.
Which you don't want if you're looking for passive income.
Exactly. An absolute NNN lease severs that final tie completely. The tenant handles the roof, the structure, the parking lot, everything. You literally just check your bank account on the first of the month.
Wow. And that corporate guarantee part ensures that the money hitting your bank account isn't dependent on like a local franchise owner who might mismanage the grill and go bankrupt.
Exactly. You are backed by the multi-billion-dollar corporate entity of Jack in the Box itself.
So you aren't really buying a building. You're buying a corporate bond that just happens to be wrapped in a drive-through.
That's exactly what it is. And they list this property at a 6.5% cap rate.
Right. And for anyone rusty on their commercial real estate math, that capitalization rate just means if you bought this property entirely in cash, you would generate a 6.5% annual return from the rental income alone.
Yeah, completely independent of the property's value appreciating over time.
But the physical location still matters immensely, of
Oh,
course.
absolutely. Because that is what guarantees the corporate entity will sign such a landlord-friendly lease in the first place. They need the location.
Right. And EBG highlights a vital metric here, VPD, or vehicles per day.
The traffic count.
Exactly.
Yeah.
The Jack in the Box sits on a road with over 104,000 VPD.
That is massive.
Yeah. And then you compare that to another property in this exact same tier, a Wendy's in Woodaway, Texas.
Right, which has a true NNN lease and 12 years remaining.
But its VPD is only around 30,000.
Right. It is still a strong corridor, but that is a massive drop in daily eyeballs, which alters the risk profile and obviously the pricing.
You see that dynamic shift again with the Beals department store they list in Chicoto, Oklahoma?
Oh, the Beals, yeah.
It's over 20,000 square feet, completely renovated, with almost 10 years left on the lease. And it sits right next to a Walmart, pulling in over 15,000 vehicles a day.
But EBG specifically markets that one as having below-market rents.
Right.
And that phrase signals a total pivot in strategy. The Beals is generating steady income right now, but the fact that the rent is below the market average hints at untapped potential.
Which bridges us perfectly to the oddballs EBG includes in this sub-3 million tier.
Yes, the properties that require a vision rather than just, capital.
Like the 37-acre plot of residential land in Cedar Hill. It's a CHISD asset sale.
Cedar Hill Independent School District.
Yeah, they're selling off surplus land. And it's offered as a sealed bid opportunity, meaning there's no asking price at all.
You just submit your best offer blindly, and they pick the highest number.
It's a pure play for a developer who wants to carve up a neighborhood from scratch.
And then look at the McKinney Medical and Office Space. It is currently operating as a gym, but EBG advertises it as selling well below county assessed value.
With owner financing available.
Exactly. Now, selling below assessed value is usually a huge red flag to a residential buyer.
Like, what's wrong with the foundation, right?
Exactly. But in commercial real estate, when it's paired with owner financing, it is an invitation.
Because traditional banks are notoriously strict about lending on vacant or underperforming specialized buildings, right?
Very strict. So by offering owner financing, the seller essentially acts as the bank. This allows a buyer to completely bypass those strict lending hurdles, acquire a distressed asset on the cheap, and execute a turnaround plan.
Okay, here's where it gets really interesting.
Oh, yeah.
Because if that first strategy was just buying safety and going to sleep, the second strategy, which is highlighted in EBG's $3 million to $7 million tier, is all about actively manufacturing value.
Right. This is where investors buy a problem specifically to solve it.
Right. And by solving it, they force the property's valuation into the stratosphere.
The industry calls this the value add strategy. Investors in this bracket, they aren't looking for a pristine, safe 6.5% yield. They are looking for financial levers they can pull.
And the biggest, heaviest lever in this entire newsletter is the Lancaster Industrial Park.
Oh, the Lancaster property, yes.
We are talking about a massive footprint here. Over 114,000 square feet of industrial space with frontage on Interstate 35E, absorbing 98,000 vehicles per day.
Huge visibility.
But the banner headline on this listing is 45% below market rents.
Right.
Now imagine you are a novice investor. You see a landlord advertising that their current tenants are paying barely half of what they should be.
Your instinct might be to run away, right?
Exactly. You'd think, why on earth would a landlord advertise that? Isn't that a giant red flag? It sounds like a failing operation.
But a value-add investor sees an absolute goldmine.
How so?
Well, to understand why, you have to look at how commercial properties are actually valued. A residential house is valued based on comparable sales in the neighborhood.
Right, the comps.
But commercial real estate is valued based purely on a math formula. It's net operating income, or NOI, divided by the cap rate.
So the income literally dictates the value.
Exactly. The income dictates the value.
Let's actually walk through that math, because I feel like this is the closest thing to legal alchemy in the financial world.
It really is like printing money if you do it right.
Okay, so let's say, hypothetically, this industrial park generates $1 million a year in net operating income at a 5% cap rate.
Okay.
The market values that entire property at $20 million.
Right.
But EBG is telling you the current rents are 45% below market.
Yep.
So if you buy this property, let the current leases expire, and then sign new tenants at the true market rate, you boost your net operating income to, say, $1.45 million.
And at that exact same 5% cap rate, your property is suddenly valued at $29 million.
Wow. You have generated $9 million in equity just by updating the paperwork.
You force the appreciation.
That's incredible.
Of course, pushing out old tenants, renovating industrial bays, and signing new corporate leases that require significant capital and a lot of legal friction.
It's not a walk in the park.
No, it's not. And EBG knows this, which is why they explicitly mention that seller financing is available for this property to entice an operator who's actually willing to do that heavy lifting.
It is a phenomenal strategy.
Yeah.
But you don't just have to manipulate the lease to create value, right?
Yeah.
You can also manipulate human psychology.
Oh, absolutely.
Let's look at the Irving Retail Center in this same tier. It is just under 10,000 square feet, built in 2021, and 100% leased.
Yep.
And the tenants are a PJ's Coffee with a drive-through, a Heartland Dental Clinic, and Tesla Superchargers.
And if we connect this to the bigger picture, that combination is definitely not an accident.
No.
No, that is a masterclass in retail curation and synergy. You really have to think about the behavioral economics of a Tesla owner here.
Okay, walk me through that.
Well, when you pull up to a normal gas station, you are pumping fuel for, 4 minutes? And then you are right back on the highway.
Yeah, you're in and out.
But when you plug into a supercharger, your vehicle dictates that you must remain stationary for 30 to 45 minutes.
Oh, wow. So you have a captive, generally affluent demographic literally trapped in your parking lot.
Exactly. They check their phones, they get bored, and they look around.
And they smell the roasted beans from the PJ's Coffee.
Right. So they walk over and buy an $8 latte. Then they stroll past the Heartland Dental Clinic and are subconsciously reminded to book a teeth cleaning.
That is brilliant.
Yeah.
The landlord has engineered an environment where the infrastructure traps the customer and the retail tenants just monetize the wait time.
It's incredibly smart. And that engineered proximity is a recurring theme in this newsletter. Take the Mesquite property EBG lists.
The Hooters, right.
Yes, it is a 4,250 square foot Hooters restaurant with 11 years left on an absolute NNN lease.
Sounds solid.
It is, but the critical detail EBG points out is that it functions as a Kroger outparcel.
Okay, an outparcel that's a smaller plot of land sitting on the immediate perimeter of a massive retail anchor, right? Just like a grocery store.
Exactly. So the investor buying that Hooters isn't just analyzing the local demand for chicken wings. They are absorbing the residual foot traffic of the thousands of people who are absolutely mandated to drive into that parking lot every week just to buy groceries.
They're drafting off Kroger's gravity.
Precisely. Furthermore, the listing notes this lease includes 10% rent bumps.
Nice.
So every few years, the rent automatically increases by 10%. The investor's cash flow scales up without them having to lift a finger. It acts as an automated shield against inflation.
Man, that's clever.
Yeah.
And EBG rounds out this middle tier with a 16,800 square foot industrial and flex space in Roanoke, Texas.
Yeah, that one sits just outside the city limits.
Right, which offers fewer zoning headaches. But it boasts short-term leases.
Which is funny because normally you want long-term stability, right?
Yeah, usually. But EBG frames this as an owner user opportunity.
Exactly.
So this is for like the plumbing contractor or the logistics company who is just tired of paying rent somewhere else.
Right. You buy the building, you wait 6 months for the current tenant's short-term lease to expire, and then you just move your own company into the space.
You effectively become your own landlord, turning your business's overhead cost into long-term real estate equity.
Which is a fantastic way to build wealth. And that brings us to the final, most macro-level strategy,
Right.
EBG's top tier, the properties over $7 million.
The heavyweights.
The heavyweights. Here, we move from micro synergies like Tesla chargers trapping customers to macroeconomic magnets that dictate the flow of entire cities.
This is the strategy of harnessing geography.
Exactly.
I call this the grocery halo.
The grocery halo. I like that.
Let's look at the Willis, Texas Retail Center. It's nearly 15,000 square feet, built in 2023. But the absolute most important bullet point on this listing has nothing to do with the physical building itself.
Not at all.
The headline is simply that it is located across from HEB.
And for anyone unfamiliar with the Texas market, HEB is not just a grocery store.
No, it is a cultural institution.
Truly. When HEB buys land and pours concrete, the traffic patterns and the economic center of gravity for that entire town permanently shift.
So you don't even need to own the HEB. You just buy the building across the street to legally piggyback off their billion-dollar market research and foot traffic.
That's exactly what you do. The industry term for the strategy is shadow anchoring.
Shadow anchoring.
Think of it like a remora fish attaching itself to a great white shark.
Okay.
The remora doesn't have to expend the energy to hunt. It just peacefully glides along, eating the scraps from the shark's kills.
Wow.
You let a multi-billion-dollar corporation like HEB or Walmart spend tens of millions of dollars on demographic research, traffic flow analysis, and, infrastructure improvements.
And once they commit to a location, you simply buy the retail strip across the street.
Yep. EBG points out another property in Fort Worth that leverages this exact same strategy, heavily advertising a new HEB nearby.
And in the heavyweight tier, there is a massive 46,000 square foot retail and flex center in McKinney that literally calls itself a Walmart shadow anchor.
Yeah, they wear it as a badge of honor. You are legally piggybacking off of Walmart's gravitational pull.
Because of that stability, you attract tenants who want to stay forever.
Right. And EBG uses a specific acronym to boast about that Willis listing. They call it an 8.4-year WALT.
WALT, weighted average lease term. Right?
Yes. It is one of the most critical metrics an institutional buyer examines.
How exactly does that math work?
Well, if you have 10 different tenants in a shopping center, some might have leases expiring next year, while others just sign brand new 10-year contracts.
Right.
The WALT calculates the average time remaining across every single tenant, but it's weighted by the square footage they occupy and the rent they pay.
Okay, so an 8.4-year WALT mathematically guarantees that, across the board, the landlord does not have to worry about a mass exodus of tenants for almost a decade.
Exactly. And from a financing perspective, an 8.4-year WALT acts as a golden ticket for securing highly favorable, low-interest institutional debt.
Because the banks love safety.
They do. Lenders look at the shadow anchor, they look at the near decade of guaranteed lease terms, and they just see a zero-risk proposition.
You see investors buying into geographical destiny across this entire tier, honestly.
Whoa, everywhere.
Like, that McKinney property doesn't just rely on the Walmart shadow anchor. It specifically boasts McKinney Airport upside, banking entirely on future municipal infrastructure expansion.
Right.
Then there's a 14,000 square foot center in Georgetown, slated for construction in 2025. The entire sales pitch for that one is that it sits squarely in the Austin growth corridor.
Yeah, they aren't selling the steel or the glass there.
No, they are selling the inevitable, mathematically mapped tidal wave of human migration heading toward Central Texas.
And this all synthesizes perfectly into a banner advertisement EBG placed directly in the middle of their newsletter.
Oh, I saw that.
It is targeted at current property owners, and the slogan simply reads, "Exit strategy is greater than exit price."
So what does this all mean for us?
Well,
When we look at all these strategies, the zero-effort NNN bonds, the NOI math of a value-add industrial park, the remora fish strategy of shadow anchoring, we realize that commercial real estate at this level is just a game of time and probability.
it really is.
You are buying 10% contractual rent bumps. You are buying the future upside of an airport runway expansion. You are buying 8.4 years of weighted average lease term right across from an H-E-B.
You are buying a highly predictable timeline.
Exactly.
And this raises an important question for you, the listener. Tomorrow, when you are running errands or just driving down the highway, I challenge you to view your environment through this lens.
Right. Take the noise-canceling headphones off.
Yes. When you pull up to a strip mall, do not just see a dentist, a coffee shop, and a nail salon. Look for the underlying puzzle.
Ask yourself, who is the anchor tenant?
Who is the remora fish in the shadow?
What is the vehicle count on this road? And why did they put the drive-through exactly there?
It fundamentally changes how you perceive the built environment around you.
It really does. I mean, we started this deep dive by asking how the commercial real estate market could possibly shrug off global turbulence and macroeconomic fear.
Right, the war quote.
Yeah. And the answer is that they have engineered financial shock absorbers directly into the concrete of our towns.
They deeply understand and actively manipulate our daily habits.
They know exactly how many cars will pass a sign,
How long a Tesla owner will sit at a charger.
and what a bored consumer will buy while they wait.
It is a stark reminder that physical architecture is heavily dictated by financial architecture.
Which leaves us with a lingering thought to chew on today. If global instability doesn't shake this market, and if human movement is so wildly predictable that electric vehicle chargers in grocery stores literally dictate the value of the dirt beneath our feet, are we actually building organic physical communities anymore?
That's a heavy question.
Right. Or are our cities just becoming giant life-size financial spreadsheets and we are just the data points moving predictably from cell to cell?
Definitely something to ponder the next time you're sitting in a drive-thru paying for your coffee.
And inadvertently paying the landlord's vet bills for that golden goose. Keep your eyes open out there.